What if I told you the Federal Reserve's aggressive rate hikes, the very policy designed to crush inflation and reassert American financial dominance, are quietly strengthening China? Sounds backward, doesn't it? After all, higher US interest rates are supposed to suck capital into America, pressure emerging markets, and squeeze China's growth. That's the mainstream story. But here's what mainstream analysis gets wrong. They're looking at interest rates in isolation. And geopolitics doesn't work in isolation. Let me show you something most analysts ignore. Since March 2022, the Federal Reserve raised rates from near zero to over 5.25%. That's the fastest tightening cycle in 4 decades. In theory, that should have devastated China's economy. Instead, China's export machine continued posting surpluses, $877 billion in 2022 alone. Not $800 billion, not around $900 billion, $877 billion. So what's really happening? To understand this, you need to see what I call the interest rate trap, a 3-system dynamic that's unfolding beneath the headlines. System 1, dollar gravity. System 2, manufacturing rebalancing. System 3, financial decoupling acceleration. Most people think higher rates equal a stronger America. But here's what's really happening. When the Fed tightens aggressively, it doesn't just strengthen the dollar, it destabilizes everyone else. And that's where China adapts. I talked to factory managers in Shenzhen last year. One of them told me something that stuck with me. When America tightens, smaller countries panic. Orders come back to us. Think about that for a second. Why would US rate hikes redirect orders toward China? Because of dollar gravity. When the Fed hikes rates, the dollar strengthens. Emerging markets with dollar-denominated debt suddenly face higher repayment costs. Currencies weaken. Financing dries up. Countries like Pakistan, Argentina, and even parts of Southeast Asia struggle with capital flight. Here's what nobody tells you. That instability pushes global manufacturers toward the most stable, large-scale production base available. And despite the narrative of China collapse, that base is still China. Let me show you the numbers that matter. In 2023, foreign direct investment into Southeast Asia rose, but Chinese manufacturing exports to the United States still exceeded $427 billion. Not collapsed, not replaced. $427 billion in direct exports to the very country tightening monetary policy. This is the paradox. The weapon that was supposed to create American strength, high interest rates, increases volatility in weaker economies more than in China. Why? Because China controls its capital account. It doesn't allow free capital flight the way emerging democracies do. When the dollar surges, Beijing doesn't panic, it manages. A senior economist once told me off the record, China doesn't need to win the currency war. It just needs everyone else to lose faster. Stay with me, because what comes next changes everything. When the Fed tightens, American consumers face higher mortgage rates, higher credit card interest, tighter lending standards. US demand cools, but not evenly. High-end consumption slows first. Budget goods, they remain resilient. And who dominates global budget manufacturing? If you want to understand global trade resilience, just look at Walmart's supplier base. A majority still traces back to Chinese factories, directly or indirectly. Here's what matters. High interest rates compress margins for US retailers. They seek lower-cost suppliers. China's scale, despite rising wages, still beats fragmented alternatives. This is the first layer of the interest rate trap. Dollar strength doesn't automatically equal Chinese weakness. In fact, it pressures China's competitors more than China itself. Most people think financial tightening isolates China. But here's what's really happening. It's accelerating structural shifts Beijing has been preparing for since 2014. When I was in Beijing during a policy forum, one official said something revealing. We study American cycles carefully. Volatility is opportunity. That's not conspiracy. That's strategy. So System 1, dollar gravity, creates instability that disproportionately hurts mid-tier economies. China, with capital controls and state banking dominance, absorbs the shock better than most. But that's just the first mechanism. Because while everyone debates exchange rates, something deeper is unfolding in global manufacturing flows. And the second system, manufacturing rebalancing, is far more sophisticated than most Western analysts realize. And once you see how that works, you'll start questioning whether the Fed's rate hikes are tightening America's leverage or quietly compressing it. Let me show you. So here's the second force at work, And this one operates completely differently. Manufacturing rebalancing. Most people think the story is simple. The Fed hikes rates, the dollar strengthens, companies leave China and move to Vietnam, Mexico, or India. End of story. But is that actually what the numbers show? Let's slow this down. Yes, supply chains are diversifying, but diversification is not replacement. In 2023, US imports from Vietnam hit roughly 114 billion. Sounds impressive until you compare it to China's $427 billion in exports to the United States. That's not parity, that's still dominance. Here's what mainstream analysis gets wrong. They treat manufacturing relocation as a binary switch, China or not China. But global production doesn't flip like a light switch, it layers. When the Fed raises rates, global financing becomes expensive. Factory construction isn't cheap. Industrial parks in India, semiconductor facilities in Malaysia, logistics hubs in Mexico, all of that depends on capital. And capital just became more expensive. Let me show you what this actually means. A 300 basis point rise in borrowing costs can turn a marginal factory investment from profitable to unviable. For emerging markets trying to absorb supply chains leaving China, this is brutal. Infrastructure projects stall, private financing dries up, governments face currency pressure. This is the part that should surprise you. High US rates don't just slow American consumption, they slow global capacity expansion outside China. I spoke to a logistics consultant who works between Shenzhen and Ho Chi Minh City. He told me bluntly, Vietnam can assemble, China still supplies. That's the hidden layer. Even when production moves, components often still originate in Chinese industrial clusters. Rare earth processing, battery components, solar wafers, precision electronics. These ecosystems took decades to build. Here's what matters. Ecosystems compound. They're not easily replicated. In 2022, China accounted for over 70% of global lithium-ion battery cell production. Not 50%, not about two-thirds, more than 70%. If US rates make financing harder worldwide, who benefits? The country that already built the ecosystem. Stay with me because this connects to something even bigger. The Fed's tightening cycle has pushed global venture funding down sharply. According to PitchBook data, global venture capital investment fell from $681 billion in 2021 to $445 billion in 2022. That contraction disproportionately affects new industrial challengers. Meanwhile, China's state-backed financing doesn't operate on the same short-term profit logic. Policy banks continue lending. Strategic sectors continue expanding. The cost of capital inside China is politically managed. The paradox becomes clearer. The policy designed to slow inflation in the US indirectly slows competitive industrial expansion elsewhere. And when competitors slow, incumbents consolidate. Here's what nobody tells you. Relocation headlines often mask deeper integration. Take Mexico. U.S. imports from Mexico reached approximately $475 billion in 2023, surpassing China in some categories. But dig deeper into the supply chains. Mexican auto exports rely heavily on Chinese components and machinery imports, industrial robots, battery inputs, steel inputs, many sourced from Asia, particularly China. If you want to understand global manufacturing power, just look at who supplies the suppliers. When I was reviewing customs data last year, something stood out. Chinese exports to ASEAN countries surged. Over $975 billion in trade volume between China and ASEAN in 2022. That's not decoupling, that's rerouting. So what's really happening? The Fed's rate hikes increase global financial stress. That stress slows new capacity outside China. Companies hedge by spreading final assembly, but core industrial supply remains deeply anchored. And here's the retention question you should be asking. If diversification depends on affordable capital, what happens when capital remains expensive for longer? A senior supply chain executive once told me, the world wants to leave China, but no one can afford to rebuild China. That's the second system. Manufacturing rebalancing under high-rate conditions doesn't dismantle China's position. It often reinforces it through indirect integration. If you're finding this valuable, hit that like button. Because what we're about to discuss is the part most financial media avoids. So far, we've looked at dollar strength and manufacturing ecosystems, but neither of those explains the long-term strategic shift underway. Because while Washington focuses on interest rates, Beijing is accelerating something far more structural, and this is where the interest rate trap becomes uncomfortable. The third system isn't about factories, it's about financial architecture. And once you see how US rate hikes are accelerating financial decoupling, not weakening China, but pushing it to innovate faster, you'll realize this story isn't about short-term trade flows at all. It's about who writes the rules of the next monetary era. Let me show you. So here's the third force at work, and this is where the interest rate trap becomes uncomfortable. Financial decoupling acceleration. Most people think higher US interest rates simply strengthen the dollar system. But here's what's really happening. The more aggressively the Fed tightens, the more it reminds the world who controls global liquidity. And that reminder has consequences. Let me ask you something. If your economy depends on access to dollar funding and the Federal Reserve can raise your borrowing costs overnight, how secure do you really feel? This is the part that should terrify policymakers outside Washington. In 2022 alone, global dollar-denominated debt outside the United States stood at approximately $13.7 trillion. Not around $14 trillion, $13.7 trillion. When US rates jump 500 basis points, the ripple effects are immediate. Servicing that debt becomes dramatically more expensive. Here's what nobody tells you. Every rate hike reinforces the perception that the dollar system is both indispensable and dangerous. When I was speaking with a regional banker in Singapore, he said something revealing. We don't question the dollar's dominance, we question its predictability. That's subtle, but it matters. Stay with me, because what comes next changes everything. China has been preparing for this volatility for over a decade. After the 2014-2015 capital outflow scare, Beijing began systematically reducing vulnerability. Foreign exchange reserves were fortified, still hovering above $3.1 trillion. The cross-border interbank payment system expanded. Bilateral currency swap agreements multiplied. Here's what matters. Financial insulation doesn't require immediate replacement of the dollar. It requires optionality. In 2023, over 20% of China's trade with Russia was settled in yuan. 5 years ago, that figure was negligible. Trade between China and Brazil increasingly uses local currencies. Saudi discussions about yuan-settled oil sales, not finalized, but strategically symbolic. This is the uncomfortable truth. Every time the Fed weaponizes interest rates to stabilize domestic inflation, it reinforces incentives for alternative payment rails. Most people think de-dollarization means the dollar collapses. But here's what's really happening. Incremental hedging. Let me show you the numbers that matter. According to the IMF, the dollar still represents about 58% of global foreign exchange reserves. That's dominant. But in 2001, it was over 71%. That's not collapse. That's erosion. The paradox is striking. The tool that strengthens short-term dollar demand, high rates, may accelerate long-term diversification away from dollar dependence. When I attended a policy roundtable in Beijing, one academic said quietly, "We don't need the yuan to replace the dollar. We need it to coexist." That mindset shifts strategy entirely. And here's what makes people uncomfortable. Financial fragmentation can coexist with trade integration. China doesn't need Wall Street's blessing to trade with ASEAN, Africa, or Latin America. It needs clearing mechanisms, liquidity lines, and political agreements. High US rates, by tightening global liquidity, give Beijing a narrative advantage. The dollar is powerful, but it's volatile. If you want to understand this shift, just look at central bank gold purchases. In 2022, global central banks bought 1,136 tons of gold, the highest annual total on record. Not 900, not around 1,000. 1,136 tons. Why would central banks accumulate gold at that scale? Because high-rate cycles remind them of systemic concentration risk. Here's what mainstream commentary gets wrong. They treat financial dominance as static, but dominance creates incentives for hedging. The interest rate trap operates here in slow motion. Short-term, capital flows into the US chasing yield. Medium-term, emerging markets experience stress. Long-term, policymakers accelerate diversification frameworks. This connects to something even bigger, and I'll show you in a minute. If rate volatility becomes structural, not cyclical, then trust becomes the new currency. A senior economist once told me off the record, financial systems fail slowly, then suddenly. That doesn't mean collapse. It means gradual redistribution. So here's the retention question. What happens if the Fed keeps rates elevated for years, not months? Does it maintain control? Or does it push neutral countries to quietly build alternatives? This is where System 3 reshapes the board. But we haven't pulled it together yet. Because the real power of the interest rate trap isn't in any one system. It's in how dollar gravity, manufacturing rebalancing, and financial decoupling reinforce each other. And when you combine those three forces, the strategic picture looks very different from what most headlines suggest. Let me pull this together. You've just seen the three systems that form what I call the interest rate trap: dollar gravity, manufacturing rebalancing, and financial decoupling acceleration. Each one on its own looks manageable. Combined, they create a strategic paradox most commentators completely miss. Most people think the Fed's rate hikes are a show of strength, and in the short term, they are. The dollar strengthens. Capital flows into U.S. Treasury markets. In 2023, foreign investors still held over $7.6 trillion in U.S. Treasuries. Not collapsing, not fleeing. $7.6 trillion. But here's what mainstream analysis gets wrong. They measure strength only in yield flows, not in structural incentives. Dollar gravity pulls capital inward, but it pushes volatility outward. Manufacturing rebalancing headlines talk about China's decline, but high capital costs slow the very countries trying to replace China's industrial ecosystem. Financial decoupling doesn't happen in dramatic announcements. It happens quietly, through incremental hedging, bilateral agreements, gold accumulation, and currency swaps. This is the paradox. The weapon that was supposed to reinforce dominance may be accelerating adaptation. Let me show you what this actually means. If you want to understand long-term power, don't just look at interest rates. Look at system resilience. China's capital controls, state banking dominance, and industrial ecosystems create insulation. Not immunity, insulation. Here's what matters. Insulation allows strategic patience. When I spoke to a macro strategist in Hong Kong, he told me, the US optimizes quarterly. China optimizes generationally. That may sound dramatic, but policy timelines matter. So where does this go? There are three realistic scenarios. Scenario 1, prolonged high rates. If the Fed keeps rates elevated above 4% for several years, the dollar remains strong. Emerging markets face persistent financing pressure. Manufacturing diversification slows. China consolidates indirect influence across Asia through supply chain integration. Financial hedging accelerates quietly. Scenario 2, rapid U.S. rate cuts. If recession forces the Fed to cut aggressively, the dollar weakens. Capital flows outward. Emerging markets breathe easier. But here's the twist. China benefits again. Global liquidity returns. Commodity prices stabilize. External demand improves. Scenario 3, fragmented multipolar finance. This is the slow burn outcome. The dollar remains dominant, say 55% of global reserves instead of 58%. Yuan settlement grows from niche to regional standard. Gold accumulation continues. No collapse, no dramatic shift, just gradual redistribution of optionality. Here's the uncomfortable truth. The Fed's mandate is domestic, inflation and employment. It is not tasked with preserving global financial loyalty, but global reactions are strategic. If you want to understand geopolitical power shifts, just look at incentives created by policy, not intentions behind it. This connects to something even bigger. When America tightens monetary policy to defend its economy, it reveals the leverage of the dollar system. That leverage is powerful, but visible leverage encourages hedging, and hedging, over time, becomes architecture. Most people think strength discourages alternatives, but here's what's really happening. Visible strength encourages preparation. That's the interest rate trap. Short-term dominance, medium-term volatility, long-term diversification. It doesn't mean China wins. It means the game evolves. Let me leave you with a final thought. In 1985, the Plaza Accord reshaped currency alignments. In 2008, quantitative easing reshaped global liquidity. In 2022, rapid rate hikes reshaped global risk perception. Every major U.S. monetary shift creates second-order effects. The question isn't whether the Fed should fight inflation. It must. The real question is this: in defending domestic stability, is America accelerating global adaptation? And if you're watching carefully, you'll notice something subtle. China doesn't need the Fed to fail. It just needs the system to adjust. If you found this breakdown valuable, subscribe. Because we're going to continue unpacking how monetary policy quietly reshapes geopolitical power. And I want you to think about this. Do you believe high interest rates strengthen American leverage, or are they quietly compressing it over the long term? Let me know in the comments.